Okay, hello, good afternoon everyone. I think before we start, I actually want to give a big shout out again to Cambriel and all the organizers of that event. It's really amazing, 2 days purely DeFi, and probably similar to every one of you guys at all the other conferences, when there was the one or the other DeFi talk, I was always rushing to that talk, and now 2 days only DeFi, so totally overwhelmed. Great conference, great content. Thanks, guys. And well, also happy that we not only cover the opportunities, but obviously also the challenges coming along with DeFi and with those great opportunities. We'll speak at that panel about the regulatory challenges. Jacek already kind of prepared us with the broader regulatory picture and the lawyer mindset during his talk previously. And now we want to focus a little bit more on the actual use case, investment funds and managing assets on the blockchain. How many fund managers are in the room actually? Quite a few. Me personally, I'm also having an asset management background, having been an investment structurer in the hedge fund space the last 13 years. So as part of that role, I was setting up investment funds, companies basically. I was writing investment proposals and prospectuses, dealing with the regulator, dealing with the entire ecosystem, with the fund administrator, who is usually evaluating the assets, with the third-party custodian, who is legally in charge of holding all those assets in the portfolio, with the auditor, with the reporting agents who are doing regulatory reporting of the funds. And I realized we created a huge ecosystem around the fact that we have some guys with money and some guys with knowledge how to manage assets and that money. So we basically just want to connect those two peers. And the industry so far is huge. We created a trusted ecosystem, but as you can imagine, this trust has been heavily misused in the past. So when I saw blockchain, my eyes actually opened up also to that opportunity that we can kind of upgrade the investment management industry with the help of blockchain and maybe making a simpler, a less costly, and a more trusted environment, trustworthy environment for those two guys, basically for the investors with money and with the asset managers with skills. So today, I'm very happy to discuss this a little bit with Mona Lisa from Melon, former Melon, and now the latest avant-gardist in the room, with Felix from Z Protocol, with Jacek from Maker, and with Ray Hindi from L1 Digital, a fund of fund in the space. And yeah, I basically, what I got to say is basically that I'm still a fund structurer, but I'm not structuring anymore the currently regulated investment funds under the UCITS regime, under the AIF regime, but I'm looking to structure the fund of the future, what we kind of call a TROF, a technology-regulated and operated investment fund. This is the vision of the non-profit association we founded 2 years ago, called MAMA, Multi-Chain Asset Managers Association. And Mona, she's actually our president. I hand over to you to maybe quickly give the audience a primer what the MAMA vision is all about.
Thank you. Yeah, so I think it was nearly 3 years ago now where we set out to build the Melon protocol, and we started to envisage, I mean, one of the key assumptions we made was that all assets would eventually be tokenized, including traditional world assets. And we started to put in place the infrastructure for the sort of future of asset management using blockchain technology. And obviously, as we all know, this was one of the first steps in decentralized finance, and it's all kind of based off the premise that it disintermediates the financial intermediaries. But when you take a step back and you look at law in most jurisdictions, the financial intermediaries are entities that are required by law, mainly to make sure that there's some kind of regulation and behavior and there's protection towards investors. So I started to look ahead, fast forward 3 years, and I thought, wow, we're working on a really, really great vision here, but the law is going to have to change to accommodate for this vision. And if we don't start now, then we're going to be behind 5 years by the time the technology is ready. So I think it was 2.5 years ago, together with some of the other Mama founding members and visionaries in the DeFi space, we came together and we founded the Multi-Chain Asset Managers Association, and we took the decision that we wanted to shape the narrative on decentralized finance, or what we call TROFs, technology regulated and operated finance, and basically be the ones in the room telling regulators and different lawmakers why the discussion has to evolve beyond just KYC, AML, which is what they mainly seem to care about. And we need to stop seeing crypto as like this evil, or DeFi as this like way that there's something to fear, but actually see all the benefits that decentralized financial technologies can give in terms of compliance, in terms of investor protections, and so on and so forth. And so the goal of Mama and the vision of Mama was really to lead the narrative on this kind of technology and make sure that we're putting in place the right types of information and discussions to make sure that regulators can make informed decisions, and that we're not having this narrative led by, frankly, the JP Morgans of the world who have no interest in seeing this technology succeed.
Thanks, Mona. So, Ray, you're obviously also Mama member with L1 Digital, but you're coming also from the old world, or also running a traditional fund-of-fund business. So how is your business, how is the industry, and how are you looking at this vision of the future?
So I think that since the crisis, the world financial crisis, with regulation coming, with the world becoming way more regulated, that, as was mentioned before, that increased the layers of service providers in terms of custody, in terms of KYC and compliance, etc. And not only that increased costs, but what we're experiencing today, and what I've experienced for many, many years, is a pretty bad service from those service providers. So just to give you some examples. Today, as an investor, between ourselves and the actual manager, there's 3 layers. And each of those layers provides you a poor service. So, I mean, you have a compounding effect at the end when you combine all those 3 layers. If you don't have a direct relationship with the manager, you probably won't even receive the monthly reports. It's that bad. So it goes. So I think the whole vision is really needed, because we've got from a service provider perspective and from an experience perspective as an investor, the experience is pretty bad. And it starts at the subscription level. If you want to subscribe into a regulated fund, and if you don't make sure that you negotiate the fees with your bank, there are examples of a very well-known bank that takes 3% upfront for a 2-minute job. So, and a real example on a 250K ticket was $7,500 for spending 2 minutes on filling a sheet of paper. Yeah. So we've got real problems there, and we've got a long way to go, of course.
Yeah. Felix, you came up with SET protocol. You're not talking funds, though you're talking managing assets. How do you see your sets fitting in this framework?
So I think what we're doing is fundamentally different to an extent. I mean, just to give the audience a sense of what we do, we make fund strategies like really easy and accessible. We use Ethereum and smart contracts to essentially cut out the middlemen. So there's no kind of actors between you as an end user and like you implementing the strategy of your choice. And the idea is that by eliminating the middlemen, you can essentially kind of cut costs, right? So it's significantly cheaper and easier to kind of implement strategy of choice. And how we do this is that we implement all the logic for how a strategy is executed completely using smart contracts. So there's no kind of human element to it, and all the inputs into these smart contracts are third-party data feeds. So whether it's a MakerDAO Oracle or maybe like an Augur auction or something that you can get on chain. That is what we also believe in addition to tokens is increasing over time. The more data that is being uploaded, we can use all that data to implement any type of strategy that can be programmed, right? And the idea is right now we've kind of been creating a few of these strategies, and over time, like any programmer, developer, or any person could essentially point and click and kind of actuate like what they want to think, right? So for example, the idea is that in the future, we don't think of asset management as like investment like products. Instead, like it's managing your assets, right? Anything that you own should be able to be managed by using a strategy of your choice, right? So for example, like if you get a paycheck and you want 20% of it to go to your parents, 20% of it to go pay off your student loans, and 20% for it to go into your bank account, you should just think it and at least be able to press a button, have it happen automatically, right? So I think that that's kind of what we're trying to work towards. And today, I mean, the name of the game is to some extent how we think about is getting adoption, right? And I think like you mentioned, like with the word, when you mentioned the word like fund, I think it's a very regulated term. We try to avoid that term altogether. Instead, like kind of how we use the word kind of baskets, and we kind of just use the term like software, right? What we're offering is essentially a way for people to just automate a bunch of behavior that they would be doing themselves, right? And that's kind of, I think at the end of the day, like what we're achieving is kind of to an extent like regulatory arbitrage, is that we're able to offer something that seems like a fund, but in effect is not, right? And that's kind of the argument we make, and we've been working kind of side by side with our lawyers to make sure that we can offer it kind of this to everyone in the world, right? And I think a key part, like I mentioned before, of what we're doing is we're trying to make this like easy and accessible for everybody, right? It's not just kind of existing fund managers and LPs who have access to the products that we're creating, but essentially it should be everyone in the world, right? And I think that's part of the vision of DeFi is this is for everybody.
And that's obviously the power of DeFi, as you just said. Previously, in the current industry, obviously you have a fund, always a collective investment scheme, meaning you have multiple investors investing into one vehicle collectively, and it's one asset manager mostly investing those assets, purely to the fact that it's very, very costly to set up a fund, to manage a fund, to maintain a fund. Hence you have, if you're not a pension fund or a very, very big investor, you have to collectively invest. And then you're falling immediately under the fund regulation, you name it a fund. And that's why we in Mama also specifically talk about funds to showcase towards the industry that the technology might be able to, well, disrupt or upgrade the industry here. But as you just said, I think DeFi really has the power to go beyond the fund terminology and completely create something else, how we manage our assets going forward. So maybe it's multiple asset managers towards one investor who is deploying a smart contract, or who knows what will come up. Jacek, you gave us kind of a broader regulatory overview of the DeFi space. How would you look at the, let's say, more specific asset management fund space with your lawyer glasses?
So first, I would start from the first word that appears here, which is asset, right? The question is what kind of assets are subject to asset management, as we are talking about right now. Because right now, these are mostly crypto assets, right? And there is a certain fundamental problem that I was also mentioning on my talk before, that there is a certain trouble with bringing real-world assets into the space. And of course, crypto assets, they have certain value on their own. It's quite amazing to see that they emerge as a completely alternative asset class. And I remember Mona's article on Medium like 2 or 3 years ago about this fundamental difference between crypto assets and traditional assets, which was really cool. Like really at that time, 3 years ago, I think it really opened my eyes. But still, you know, there is like we can clearly see that the market cap of crypto assets is quite limited so far, right? So if you really want to make a change, we should bring those real assets into the game, and that's also, you know, I think that the end goal ambition of set protocol as well. You mentioned like fiat money that you can manage in that way, which is not possible right now because you just cannot usually receive your paycheck it's possible, right, to do it with DAI and so on, but that's not obvious. It's difficult to reach mass scale with it. And the problem of bringing real world assets into asset management is of course broader than just specifically asset management, but it's fundamentally affecting it, and it also has legal reasons. And this is what I was mentioning about the difference between registered and bearer assets, because most of the assets out there on the financial markets are registered assets, broadly speaking, which means that they have this layers of intermediaries included in the very nature of these assets, right? Which are not your property, but which are a certain claim on some other people, right? And that's why it's difficult to bring them into DeFi and into, let's say, decentralized asset management, because they are following these principles of outward of intermediaries dominating the financial markets. So that's the first thing, that we won't be able to speak mainly for legal reasons. We won't be able to speak about really asset managements moving into this this new direction, technology regulated and operated funds. But there are also, of course, specific problems with asset management itself, and I would point out that two. The first one is like looking again at my presentation. The first one is like just an example, a very immediate problem of issues with custody. So that, you know, again, like self-custody is completely, maybe not completely, but quite you know, idea that is far away from the traditional industry. Yet here is possible for this type of assets, because like anyone can be theoretically a holder of a private key that controls a certain asset, which is not necessarily the best choice always, but there is this possibility, right, which is excluded right now very often from the regulatory framework. But also we have more fundamental questions, I think, that are present in many jurisdictions, which is about, you know, like asset management or operating funds is a regulated activity, right? And here we are talking about, at least theoretically, about systems that do not have this central operators in a way. So this one asset manager that sits on the top of each fund and manages the assets. And this is a more fundamental problem that would really require quite a deep switch in the financial regulation to these new concepts.
And I think I would just add that what we try to do here is much more than, I mean, we look at the asset management infrastructure and value chain as a whole, and we say, okay, we want to make it possible, at least within MAMA, that any kind of asset management strategy can be on-chain in a decentralized way with full security and compliance without having to worry about any kind of gray zone. So with all due respect, Felix, I think it's a little bit naive to think that just because the strategy is automated by smart contracts, which are still at some point pushed and controlled by a human at the other end, that you're just in this regulatory arbitrage zone. I think that there's still like a lot of gray area that needs to be defined clearly, and a lot of us, you know, are still in this gray area zone where we, you know, there's other arguments we could make, for example, on the asset manager structure, like if it's an investment club, you don't have to be regulated, or if you're XYZ, you don't have to be regulated. But the truth is, Coin Alpha, for example, was a great example of how they didn't do much, you know, but they still got into trouble with the SEC. And especially in the US, I think people have to be very careful in terms of that gray area, because there's absolutely no precedent. This stuff hasn't been done before, and we can see very clearly that some regulators and some governments really want to shut this whole thing down as quickly as possible, and it's a lot of it is driven by fear and lack of education. And I think if we can do our part to make regulators and legal aware of the benefit of the transparency, you know, that you get a lot of problems in the traditional asset management world due to the lack of transparency. Ray, you touched on, you know, the high costs, but also, you know, I think an even more interesting aspect of what you talked about was how little information you actually get at the end of the day. And actually, that's what you're paying them for. You know, you want to get your investors want to get information. They want to get transparency. They want to make sure you're not running off with their money or spending it in a way that they can't justify. And yet, you're not able to, paying all those fees, you're not able to provide them with that daily transparency. And I think that's the thing that we all have to, in this room, be fighting for, making regulators and government aware, you know, or kind of the legal writers of the on-chain asset management future aware of all the benefits of the technology. You can get this data on demand, you can get it immediately, you can spot malicious behavior immediately, and you can basically, you know, do that in almost real time and very transparently. And I think that's the conversation we need to be having, you know, really raising awareness of the benefits of this technology. And frankly, let's stop talking about, you know, the very few disadvantages. I'm so bored of the KYC AML discussion. This is a solvable problem. But the other side of it is how much benefit and value this technology can bring to the asset management space.
And it's obviously also always about expectation. So this vision is obviously not going to be real in 24 months or in 3 years, but we are talking 5, 10, 15 years from now. But I'm sure in 20 years, when we are looking back, we are seeing a logical step and upgrade of asset management as such. And on the way, we are doing small wins. So for example, in our discussions with the Swiss regulator and other regulators, especially in Switzerland, we made it into the Swiss blockchain report, which was issued end of last year, where they more or less quoted us that it's theoretically conceivable that investment funds of the future will be fully on-chain. So not only the shares will be issued as a token, but the entire services and the whole fund itself will natively be on-chain. And these are the small wins on the road. We are trying to push that with use cases, with sandboxes, together with the regulators to really showcase how the future can look like. Ray, from your perspective, running a fund of fund, what's the key thing, what's missing? I mean, we talked about the custody legal issues, we talked about the tokenization. What's missing that you're basically starting your on-chain fund tomorrow?
So of course, right now, even if I wanted to start the on-chain fund, I wouldn't be able to because of the regulator in Liechtenstein wouldn't allow us to do so. But I think that one of the so of course we're in active management, and where our job is to essentially select talent out there that can outperform with a certain amount of risk. And I would say that one of the key triggers for us to start pushing really heavily is there's two major points. One is talent moving into the space, because after all, we're running after a talent pool. We need to be active within a talent pool. So you need to have a pool of talent that is on-chain as well, which is quite important. And also, I think this is something that we plan anyway. There needs to be, I think one of the catalysts, and that's a bit of an unknown, is to potentially have a strategy that works on chain, that adds value to our portfolio, because at the end of the day, we're investors. We've been used to all the problems that we have off chain, and we're dealing with it. But our priority is to generate returns and manage risk. And there could be strategies that could work on chain better than off chain. And so the plan is that once our portfolio is ramped up, which has taken some time, and we start spending some time understanding and researching what's going on chain, starting with liquidity provision strategies on DeFi as a first step into it. But yeah, you need to experiment so that you can see those waves of strategy come on board. I think that's the main catalyst for us.
And then, of course, again, the jurisdiction play, which jurisdiction will open up first. also with the fund laws, what we see, and we again see small steps, for example, in Liechtenstein, again, the smaller jurisdictions, they're very close to actually natively issue fund shares and not just mirror the real fund shareholder register in a token format. But then again, that's one step forward, but 2 steps back is actually that those tokens then need to be held in custody with a third-party custodian. So again, that's how we are moving forward, really very small steps, but again, we are at least moving. Jacek, from your perspective, do you see jurisdictions leading the path here? And Felix, what's your view from the US also in regards to the SEC?
So today I just heard a few words from some Britons about the UK that will start thriving in the DeFi space, thriving the DeFi space just after Brexit. Perhaps that will happen. Well, I think that I expect that countries such as Switzerland and Liechtenstein, so those smaller but with a very developed asset management industry, will lead the way, I think.
From the US's perspective, I mean, it's one of the strictest in terms of regulations. So, I mean, there are multiple regulatory bodies that we need to be aware of, right? There's the SEC if we are dealing with securities, which is one of the reasons why we deal mostly with non-securities on token sets, right? We only offer Bitcoin, ETH, which are both assets that they have deemed non-securities, and we do USD-based assets too. The other jurisdiction is really like the CFTC, right? So when dealing with commodities, are we facilitating swaps or any types of pooling behavior, right? We make sure to know if we have any risk of any assets. Today we do not, that we are kind of aware of it, and we at one point did speak to the CFTC and the SEC about this type of stuff. They do have an arm that is kind of like progressive and trying to understand what's going on. It's called Lab CFTC, and they do kind of office hours, maybe like every few times a year, right? So we try to attend those when we can, and of course a number. One of the strategies that startups use, kind of when thinking about new products, is like essentially sending kind of a letter in no name to regulators, right? To try to get their initial gut reaction, right? So I think in general, like the U.S. regulators are not like they're not trying to just block technology altogether, but they're trying to prevent bad behavior from happening, right? Can you steal people's money? Are you essentially offering a security and saying it's not security, right? Everyone has been applying kind of the Howey test, right? So that's really important. I think the last thing that we have to worry about is essentially kind of money transmission related stuff. So I think being non-custodial definitely is really important for that, and having no ability to manipulate or move people's funds is really important too. So I think, yeah, we're definitely wary of all the things that are happening, and we literally spent like 6 months trying to figure out regulatorily how to offer the kind of the products that we've been working on.
Yeah, so maybe the weight from CeFi to DeFi is then also the gray area where we are setting up some funds on a permission blockchain maybe. We are seeing some initiatives in Switzerland, for example, with the SDX, the Swiss Digital Exchange, where stocks will be tokenized soon on-chain, but obviously a permission blockchain. And based on that, you can also imagine that they're letting banks then manage those assets on the permission blockchain, so running kind of a fund in that permissioned way and also fully regulated. So that might be halfway through to our goal. And in the meantime then, if technology develops also further, if the tokenization continues, then we really can see where we are heading towards in 5, 10 years from now. So I want to open up for questions from the audience as well, especially the crypto managers out there. Also very curious what your experience, especially when you're managing a crypto fund, which is the beast in between both worlds. Basically, you're running still an off-chain structure, but you're having to manage on-chain funds and tokens. I think that's the worst of all things, right? The costs probably increase even more, and you have to deal with even more legal issues. So what's your view on that? And we are very curious to hear about and to get in contact with you.
Any questions?
Hi, thank you. We spoke briefly last night, but just, I guess, for a bit of background, for us, we run a crypto-native fund investing in crypto assets directly. The biggest challenge for us was actually finding an administrator that understands how to handle these assets. And, we have something like 80 different wallets that need reconciling every single month. And so finding the expertise in that space was, the largest part of this process. But to give some perspective, the setup of the fund, from start to finish, took about 9 months. Just trying to piece together, jurisdiction, legal, regulatory, but then the background of sort of finding an administrator that knows what they're doing. And then the final hurdle was banking. Which I think everyone is aware is obviously a challenge in this space. But when you're running a fund that is partly investing in privacy coins, as an example, that directly contradicts, every bank's AML policy, really. So that was a challenge. And the options for banking, for crypto funds is very small. So, yeah, it's just a bit of color.
Hi. So Ray, how do you look at jurisdictions when you're assessing, let's say, a smaller jurisdiction that might be more flexible or even outright not care about what you're offering out of their jurisdiction versus somebody like a US or UK or Switzerland, which I would argue is also kind of a fairly conservative jurisdiction when it comes to these kind of things. So for example, if somebody sets up a tokenized fund out of the Seychelles or Vanuatu or something even worse, clearly that's not going to be, maybe that would work for some investors, but for most investors that would be a no-go, right? So how do you look at that when you look at managers, and which are in your realm acceptable jurisdictions, and what are the kind of the pros and cons that you look at there?
So just to be clear, I would say that 95% of the positions that we have, or the investments that we have, they have traditional setups. So Cayman regulatory framework, limited offshore fund, and we find this acceptable because as soon as you move into stricter jurisdictions, I'm thinking about Liechtenstein, you lose a lot of flexibility, and essentially you're very constrained in terms of strategy that the manager can apply. While as a fund of fund, I can say in Liechtenstein we set up our fund in 3 weeks. But of course, it's different. We're a fund of funds, so it's easier. We hold fund shares, but still, it's pretty quick to set up a fund from start to finish in 3 weeks. I would also say that the service providers within the space are, that we've due diligenced. There's a lot of concentration. There's one major administrator that services most of those funds. But at the same time, the service is not great. You get, estimates pretty late and finals pretty late. So it's very challenging. But I would say that it's plain vanilla, but with, moving through each vertical and due diligencing every service provider out there. And you've got more traditional ones that are coming on board as well.
I would love to make a comment on your question as well, which is that as we move towards, raise from the more traditional crypto fund, and I think as we move towards on-chain finance or decentralized finance, I think the actual, regulatory jurisdiction doesn't matter so much, because let's take a step back and think about what your question really is asking. You're saying that, well, some regulatory jurisdictions may offer you more security because they are more reputable, in terms of taking action against malicious behavior or spotting malicious behavior. But we're here talking about decentralized finance, and in particular, we're talking about smart contracts which can technology regulate and operate a fund now. So essentially they replace these intermediaries being the regulators, the administrators, the operational layers. And you're arguably regulating asset managers or funds or any decentralized financial applications now with technology in a much more transparent environment, which actually you could say, or at least I would argue, that's much better than the human intermediaries in a non-transparent environment. So, you know, does it really matter at the end of the day which jurisdiction is going to give you the legal wrapper, or does it matter how good the technology is?
Depends on time frame, in my view. I think, like, if you look at even like UCITS and some of the other structures, like Hans-Jörg was referring to, there's a ton of stuff that's going on there that's not okay, right? Like there was some fund in the Swedish pension system that just kind of blew up, like, you know, $500 million on some shit investments that were going through structured products and stuff like that. So that's happening all the time, right? So I love the transparency of the technology layer and, like, you know, the ability to actually show and alert investors really early on, almost like near real time, if it's on chain. So that benefit is super clear to me. What's like not clear is like, who's going to invest in that if it's not coming through a conduit that's, you know, regulatorily wise accepted. And today there's like nothing out there. I know you guys are working on it, but it's like there's nothing there.
Yeah, no, I take your point, and I think that it will just be a matter of time before there is something there. But I'm just saying that it starts to matter less whether, because I think your original question was, you know, smaller, low-hanging fruit jurisdiction versus reputable. And I'm just saying that it doesn't really matter who the first legal wrapper comes from, as long as, you know, the technology is allowed to showcase what it can do. And by the way, like you used the buzzword there. So for those of you guys who are not familiar with UCITS funds, they're very highly regulated funds which have very, very strict parameters on what you can and can't do. And even UCITS funds blow up.
Yeah.
And the reason, because I used to have a UCITS fund, the reason UCITS funds blow up is because of the lack of transparency and the inefficiency of these financial intermediaries. And these guys, they have lagging information, T+2, T+3 settlement. You know, sometimes you can have a breach and you don't even know about the breach and your risk limit until 3 days later. And by the way, by then it's too late.
Absolutely.
So I think, you know, we need to change again, or lead the narrative of this conversation, and remember where we're going and not where we're coming from, because technology enables us to do a lot more now.
So maybe that would imply that, you know, if you went to like a Bermuda, where I happen to know the regulator, or some other place which like more conducive to new stuff, and show them how this works, they would actually be, you know, willing to put it through. Possibly.
Absolutely, yeah, I think so.
So we've heard a few comments about how we should educate regulators, that their understanding of this may be too limited to actually give you good advice or help you figure out how to do things. From your experience with regulators, your encounters, your talks, what do you think is their level of understanding? Which concepts did they grasp? What did you have to explain to them? How did you go about trying to explain what you're trying to do and how that fits into their mission?
Well, what we achieved so far in talking to the regulator is, first and most important, we get their interest. They are listening to it, which is very important. I mean, they have plenty of other things, obviously, to do and to implement immediately, whereas we are educating them about the future. But they are very open, and what they obviously immediately get is the transparency point here again. So all this regulatory reporting, all what they require to get from the traditional funds currently, because they are so intransparent. You always have to daily send regulatory reporting to them. It's all Excel-based, more or less. And with the transparency of blockchain, they can immediately get that from basically the setup of the fund with the predefined parameters like fees and all the positions. They love that transparency, obviously. And so we are very close to basically do one or the other sandbox in cooperation with a regulator. So they are all ears about that, and obviously they know it's not going to change the current system tomorrow, but they're really prepared for the future as well in so far. The guys who are even more interested and more excited about it than the regulators are the actual next generation of asset managers. So we've partnered up with a couple of universities, and we are running lectures, including on-chain fund management competitions, whereby we tell the students, the young people who are probably the next generation asset managers, about the primers of blockchain and asset management, set them up with the technology and let them manage their on-chain fund for 2-3 months. We invest ourselves, so it is a fun game. It's not a regulated fund per se. That's the beauty, that we can speak about that openly without getting issues with the regulator, because it's really a closed environment for education purposes only. And I do think that's at least so important than speaking with the regulator as well. So it's really the mindset of the industry and the next generation which needs to be changed prior to having the paragraphs in the actual law be changed.
I have a general comment that does not relate to asset management industry specifically, but to the approach of regulators in general. So first of all, these guys do not like revolutions. Because their task is to be in control over what's happening, right? They will never agree to any revolutionary steps. They prefer much smaller steps that guarantee that they're still in control over what's happening. But also, these guys are very busy. They are not just dealing with innovation. And like one very concrete example that I have, because last week I had an opportunity to talk to a few global representatives, like people that work at some global regulatory bodies in some major jurisdictions. And they, like, for example, DeFi, of course, it's super interesting to them. But their immediate problem, to be honest, is Libra. Which is of course, from our perspective, people in the DeFi movement, is not necessarily the most interesting thing out there. But from their perspective, it is something that is happening, that it can already can very quickly have a scale that they wouldn't be able to react to, right? And they have to devote a lot of resources and attention to such things, and not necessarily have perhaps as much as it's necessary to some innovation that could change the industry. They would, as I said, they prefer to take rather small steps, hopefully in the right direction.
Maybe just one last small comment on regulators. I actually think that they're in a very tough position, because when things go wrong, the regulators get blamed for everything. And when things get right, the politicians take all the credit. So it's a really, difficult mindset to break, because they're always on the defensive, and they're always like, they know they're in this difficult situation, and it's like kind of managing that to some degree. Because ultimately, 2008, it's always the regulators that get, persecuted.
Okay, one last question. Otherwise, time is up. Thanks, everyone. Thank you.